And this is quite timely because it's Andrew Boss talking about, in fact, financing things such as obviously defect repairs. Are you in the room with us, Andrew?
Indeed, I am, Sam. How are you?
Hi, good. Nice to see you, Andrew. So obviously, unfortunately, we're not seeing the end of defects anytime soon. And I know when I first started doing this job, I had a lot of, builders and repairers that say to me, Sam, don't put us out of a job. And I said, gentlemen, there's 20 years worth of defects for you to be fixing and also financing. Don't worry, I'm not going to take your livelihood away from you anytime soon. But are you seeing kind of like an increase in the need for your kind of services to actually fund these kinds of defect repairs?
Yeah, absolutely. So we've been providing strata loans for 4.5 years now, and it is very the building defects. Whether it's the incidence of building defects or whether it's just the obligation now for owners to get them fixed, it's probably a little of both, but more the latter. And it is now becoming increasingly urgent. It's a reality that owners have to face into, and with that urgency is a requirement to take action. And what we're finding is that flexibility of funding, of funding choices, it can often help. It can often help break a deadlock between owners if there's choice of how these major projects are to be funded. It can make the difference. And indeed, I've got a case study at the end of the presentation that talks just about that, about a project that had been deferred for a couple of years because the owners couldn't reach agreement on how to fund it. And with a product that we offer, that project's now almost complete. So it's in otherwise what's a difficult situation for owners, this can ease the pain a little, if you like.
Yeah, and delays cost money at the end of the day, don't they, Andrew?
Yeah, absolutely.
Right? And it was interesting because I was having a conversation about decennial liability insurance recently with Victoria, and even that situation, the providers are saying, well, listen, if we identify there's a defect and, we identify the cost as $1 million and we're going to start works, and then the committee delays for 3 months or 6 months in terms of who they're going to choose, and then the defect repair is 1.3 million, we're only paying the $1 million. We're not paying the extra 300. So, owners need to be aware of the fact that, every day costs you money. So there's no use in delaying. So tell us a bit more about what you guys are doing at Firstrata.
Well, let's start with a video, Sam, and if you can share your sound.
When there isn't enough money in your Strata scheme sinking fund to cover the cost of a project, you have 3 options: a special levy, standard strata loan, or a Firstrata hybrid loan. With a special levy, you typically pay your share of the funding amount required before the project works begin, so that funding is locked in before large building contracts are entered into. The benefits of a special levy are no loan and no interest. The drawbacks are some owners may not be able to afford it. If some owners don't pay the special levy amount when it is due, the building contract and the project commencement may be delayed. If you don't pay the special levy, you can lose the right to vote and can be forced to sell your apartment to meet the special levy commitment. And your strata manager and committee can spend a lot of time dealing with overdue levies. The second option is a standard strata loan, where your strata scheme takes out a loan from a strata lender such as Firstrata Finance. Note this is a loan to your strata scheme, not to you as an individual owner. The loan is unsecured. There is no credit assessment of lot owners, and the title of your individual property is unaffected. Loan levies are charged to all lot owners by your strata scheme, with the proceeds collected being used to meet the loan repayments. The benefits of a standard strata loan are the loan approval provides evidence of funding, allowing building contracts to be signed and the project to commence. Loan funds are available to pay builders when required. And, most importantly, the loan gives you time, spreading out your financial outlays over the life of the loan. The drawback of a standard strata loan is that all owners pay interest, even if you have the funds available to pay your share of the project cost. The third option, pioneered by the Firstrata team, is a hybrid strata loan, The Firstrata hybrid loan combines the key features of a special levy and a standard strata loan by providing all lot owners with the choice of using your own money or borrowed money. The benefits of the Firstrata hybrid loan, like a standard strata loan, the approval provides evidence of funding, allowing building contracts to be signed and the project to commence. And loan funds are available to pay builders when required. Additionally, the key difference with the Firstrata hybrid loan is that for those owners who can afford it, you can pay your share upfront and pay no loan interest. Watch our Firstrata hybrid loan video to learn more about this innovative strata funding solution and whether it might be right for your strata scheme.
All right, just click there if you might. And Sam, I'll just say click each time.
I can do that.
Because there's a few of them.
I can
so
see.
Click.
I did run through yours in advance, Andrew.
All right, if you click there, please. So just to touch on a few of the key points and to reinforce, I guess, the message from the video. Your first option as an owner's corporation or a body corporate or a strata corporation, your first option is a special levy. And we say this to all of the owners that we present to. This is the simplest option. This is the simplest option if you can all afford it. If you can all afford it, go with a special levy. There's no loan. You don't have to worry about that. Your owner's corporation's not encumbered with a loan. But yeah, to the point there, oftentimes, not every builder requires evidence of funds. A lot do. They want to see that if a special levy is utilised, they want to see that the money's actually in the account. Because what they don't want to be left with is their team on site and they submit a progress claim and they don't get paid. No builder wants to see that. And the other elements, obviously, with a special levy, if you can't pay, there's the financial hardship for those who can't pay and all of the consequences with it. More fundamentally, if the builder's not going to start until the money's available, then your project can be delayed. And to Sam's earlier point, the cost escalations. It's probably fair to say that building costs or cost inflation in the last 12 months has tapered off relative to what was occurring in 2023 and 2024. We saw some abhorrent price increases on these defects projects, but nevertheless, with every month that passes by, the risk of cost escalation increases. All right, click there if you don't mind, Sam. With a strata loan, yes, this is a loan to your strata scheme. It's not to you as owners or committee members. It is an unsecured loan. There's no look through to individual apartment owners, and that's because any apartment owner can sell tomorrow. So it's a loan. The assessment is done based on the strata scheme's ability to repay the loan. The owner's obligation is to pay levies. And then the third option is the hybrid loan, and that combines elements of a special levy and a strata loan. Just click there, Sam, please. This is a schedule that we provide to all owners. It's part of a suite of documents that we provide. And the reason I've put this here is this is the document that shows the choice that owners have. And this is an example. I've obviously blacked out the strata plan number, but this is an example for the first 10 lot owners in this particular scheme. This was the choice that they had. Here's your upfront payment amount as compared to what the ongoing quarterly loan levies look like. So this is what this hybrid loan product provides. You've got a choice, folks, as to whether you pay up front and you won't pay any interest if you pay up front, or you can spread out your commitments over the life. In this example on screen is over 5 years. You can pay those ongoing quarterly loan levies.
And I think that's important, Andrew, as well, is that you can do you may have the works done now, which might take 12 months, but you have got that 5 years or longer to pay off that kind of loan, which I think is also kind of eases the pain, doesn't it?
Yeah, absolutely. And, we provide loans out to 15 years for the really chunky projects. Some of our customers take a 15-year loan term because it spreads out those levy commitments so that it is manageable.
Yeah.
All right, in terms of how does this product work? And so we have a term for those owners who pay up front. We call them a self-funding owner, or an SFO for short. So they pay their money up front. Sam, you might just click there. And Firstrata, we provide the rest of the money. The self-funding owners, they pay their money not by way of paying a levies invoice. Rather, they actually lend money here in New South Wales to the owner's corporation. So it's a really important point. The self-funding owners are lending money to the owner's corporation alongside Firstrata. Loan levies are charged by the owner's corporation to all lot owners, and that's a critical point. That's the part that is required by strata legislation. Everyone has to be charged loan levies uniformly in accordance with your lot entitlements. So you might think, well, hang on, if I'm a self-funding owner, why am I being charged levies? Well, the point there is, as a self-funding owner, you will get charged levies, but you get an offsetting credit. Just click there, please, Sam. So on your quarterly levies invoice, you might be charged $500 admin levies and $1,000 capital works levies. You'll be charged $2,000 loan levies, but there'll be an offsetting credit. So as an SFA, you have no more to pay. All the other owners simply pay their loan levies just the same as with a standard strata loan. Just click, please, Sam. Okay, in terms of some of the features of this hybrid loan, just to explain a little more how it works. If you want to be a self-funding owner, it's a one-time option. You pay at the outset of the loan, and indeed you pay the full amount. So if your share is $30,000, you pay the full amount. There's no option to partially pay. And the rationale for these first 2 points is to make life easy for the strata manager. Next point is, as a self-funding owner, you pay your money into a separate trust, and in our presentations that we do to owners, we talk about the trust and the various protections in place. I won't get into that today, but again, that is to make life easy for the strata manager. Now, if you do sell your apartment as a self-funding owner, those credits that you get, they transfer to the incoming purchaser automatically. So that if you own lot 1, and you're a self-funding owner, lot 1 is going to be a self-funding owner for the life of the loan. And equally, if the owner of lot 2 is not, it's a non-self-funding owner for the life of the loan. Again, for administrative ease for the strata manager. Now, here's a key point. In acknowledging that owners pay up front, if you want to be a self-funding owner, and let's say your project goes really well and there's no variations, any unused amount of that payment that you've made up front as a self-funding owner, that comes back to you. Obviously, it comes back to you, but even if you've sold your apartment, it comes back to you. Now, the next feature of the product is, and this was built off the back of feedback from various owners who said, hey, if I pay up front as a self-funding owner, and what happens then if one or more of the other owners don't pay those ongoing levies? Does that mean I need to chip in more? And the short answer to that was ordinarily yes, would be that situation. What we've created is this, it's like an overdraft facility for the owners corporation, whereby if there are loan levies arrears, the overdraft can be drawn on. Now, the interest rate on the working cap facility is the same as on our term loan, and our expectation would be that the owners corporation charges interest on the overdue levies, which covers the interest on the working cap facility. So it's an insurance policy. And then the next point, that's just a commercial point. Let's move on, Sam.
Okay.
Oh, that hasn't come through very well.
No.
I don't know. I'm not sure what's happened there, Sam.
That's okay. It looked better when I looked at it yesterday, unfortunately. Sorry, Andrew.
Yes. No, that's all right. I might talk briefly. So just in terms of the process, and the first step is a loan proposal, if you can kind of make out the wording there on the page. Who can get a loan proposal from us? Anyone can. Oftentimes it's the strata manager or it's someone on the committee, but just as often it's a lot owner. Lot owners reach out to us because they want to know, hey, tell me more about this flexible funding option that you have. And we'll provide a proposal to anyone, an owner, committee member, strata manager, or indeed a consultant to an owner's corporation. Just click there, Sam. Then, if the committee and the strata manager, if they think this might be a suitable solution for the owners corporation, they'll request the motions and the documents, which we provide, and then they are distributed with the notice of meeting. Okay. We hold a mandatory information session, and to Leanne's earlier point, communication is critical. Communication is critical. That's why we hold these information sessions. Oftentimes, it's a week or two before the general meeting, so that the owners, they can hear what this product is, they have the opportunity to ask questions, and it's before they're being asked to cast a vote. Then at the general meeting, obviously, the votes are cast, etc., etc. If the owners, just click there, Sam, if the owners choose to proceed with a hybrid loan, then the strata manager will submit a loan application to us. There's a point here. We obviously do a credit assessment. We're a lender. But loans to owners corporations are regulated consumer loans. And there's a point here. We have a legal obligation to perform a responsible lending assessment. So we need to prove, amongst other things, that the loan's not unsuitable in meeting the owner's needs. And owners can request a copy of that assessment, and some do. Now, the next point, and this is unique to hybrid loan, this is the part where we actually collect the monies from the self-funding owners. And this is a process that we do. It doesn't involve the strata managers. Again, as part of making life as easy as possible for the strata managers. We generally allow a month for this process, and all of our interaction with the owners is digital, in terms of registration and document execution and the issuance of payment notices, etc. And then the last step is accessing the money and drawing down the funds. Let's talk about a couple of the case studies, and this was the one I alluded to earlier. We were approached by a committee member of a 64 lotter in Campbelltown. This was earlier this year. And this was a project that involved waterproofing and replacement of the facade and other restoration works. It was around $45,000 per lot owner, 2.8 million all up. The owners had been fighting for a couple of years. They could not reach agreement on how to fund the works. So the hybrid loan, that was what broke that deadlock, the funding deadlock. Just click again. In terms of the split, so 700,000 was funded by self-funding owners and 2.1 million was funded from us. And happy to say that building contract was signed and the works, they're actually almost complete. So,
That's good news.
The product allowed the project to proceed. Just click on to the next one, Sam. This is a different type of case study. So this is a 27 lotter in Drummoyne, and the average cost was about $55,000 per lot. Now, most of these owners could afford a special levy. Most of them could, and had it gone to a simple vote with a simple majority here in New South Wales, a special levy would have been approved all day, every day. And probably reflective of the community that existed in this building, but equally some self-interest as well. What the owners wanted to avoid was disadvantaging the minority, because they knew that there were a bunch of owners who couldn't afford to pay. And what they didn't want to happen was for those owners, to have to sell their apartment and, running the risk of distressed sales. So the hybrid loan was the solution for that scheme. Just click there, Sam.
And then it shows the level of care too, doesn't it?
It does show a level of care. And it's reflected here. I mean, our resultant loan amount was only $250K. So the majority of that was funded by the self-funding owners, by the owners themselves. So they were looking after the minority. But the point being, all the owners were given the choice of when to pay that suited their circumstances best. And, it's an outcome that all of them voted overwhelmingly to proceed with. And, a good outcome for all, we'd argue.
I think that's really important, and that's an example of a harmonious community, because they're actually taking into consideration everybody's needs, and the work needs to be done. But at the same time, they were conscious that there was going to be some, especially if you've got elderly people living within the community and they're on a pension of something of that nature, for them to actually have to pay that levy or that, special levy is difficult. And certainly, at the end of the day, from our perspective, we want to make sure that, the funding is not a deterrent to getting the work done, because so many times it is, right? And ultimately, what you want to do is be a circuit breaker in this situation, which is exactly what Firstrata is doing, right, by providing this option. That's exactly it.
It is very common that you have two cohorts of owners in an apartment building. You have one, and we hear this often. from people say, listen, I haven't had a loan for 15 years. I don't want to pay any loan interest right now, and particularly not at strata lending rates of 8 or 9%. Not interested in that. I want to use my own money. And then you have others who, may have bought an apartment only 6 or 12 months ago with a mortgage at 90 or 95% LVR, and they have no capacity to find $50,000. So, this is a common ground.
I think the self-funding owners as well, I wasn't aware of this fact, but, that if they put the self-funding, kind of option up and then they sell their apartment, what they're doing is actually demonstrating goodwill to the incoming buyer. Right. And, karma is a big thing in my books, Andrew. But then obviously if you come in under budget, you get that refund, which I think is really honourable as well, because not many financing companies would actually give you a refund.
I think in terms of pub test, absolutely. But legally, they're entitled to get those funds back also. That because they pay up front and there's a contingency factor in every remediation loan that we write, if the project goes well, they should get their money back, any portion that's unused.
Well, I think that's really awesome. I really do. All right, so we will go to the next slide. And if there's any questions, you nailed it. You did. You got it done. You got it done within your 28 minutes. And I know that I was in a meeting, an online meeting, where, in fact, Firstrata was offering the hybrid loan. And, it's a very, very difficult situation. And, people are saying, but we've bought this apartment, why are we having to pay for the defects? And it's a really good question, right? And in this instance, we had about 150 owners. Majority of them were overseas. English was not their first language. And, I was actually engaged as a proxy to say no to this. But at the end of the day, I spoke to the community and I said to them, you're going to have to get these defects repaired, whether you like it or not. And, if you defer it today, and certainly, having to wait for an AGM sometimes can be 8 months, 6 months. We always encourage, if you're looking at a funding situation and you need to make a decision about a special levy, that you should call an EGM and get it dealt with sooner than later. And those people made the right choice in that room, and they said yes to the funding, and the work started. And, that was a $9 million kind of scope of works. So it wasn't anything to be sneezed at. And so I was very grateful to those owners that they actually were listening and actually then decided to stop procrastinating. So Elizabeth asks, how long have the hybrid loans been available in New South Wales?
4 years.
4 years. So your strata manager might not be providing you with that option, Elizabeth, but you can call Andrew and have a chat with him separately. And then if you need my advocacy to bring it up with the strata manager, I definitely can do that. So, because do you see that happen often, Andrew, where people reach out?
Yeah, there's some trepidation amongst the strata manager ranks about the hybrid loan and the work that's involved. And if I'm to be completely transparent, I think about the hybrid that we had in market several years ago, and the work involved for a strata manager was not insignificant. But we've worked extremely hard on the product in terms of making it significantly simpler for the strata manager. And that kind of, without going into detail, that involves having reached out to strata auditors in terms of the back-end financial mechanics, where we've paid for development in some strata software platforms. We will pay for more, and we will probably integrate our systems with some strata software platforms to get to the point where the amount of work required by the strata manager is negligible. So I can understand the reticence amongst those who've not been exposed to it recently. But to give you a guide, I think it's close on 40 different strata management firms, and many of them are now repeat customers who've utilised the hybrid with us. So
I agree with that. And also, dare I say, if there's commissions from some other strata loan companies, that may show an allegiance by the strata manager to those companies. But at the end of the day, the strata manager must take direction from the committee. And if the committee
Absolutely.
says we want this hybrid loan, while it may require more work, they can charge for that under the Schedule B, right? And they shouldn't be using their own prejudice against, a company that offers hybrid, that they should be letting their owners, a bit like with Brendan and his tendering, they should be letting owners have all the options, correct?
I couldn't agree more with that sentiment, and not quite there yet. I would say some firms, but really pleasing that the majority are, and the prevailing mindset amongst the progressive strata management firms is that we are here to fulfil a role for the owners, and that's absolutely the case.
Yeah, correct. So there you have it, from the horse's mouth. Hybrid loans are alive and kicking, and certainly if you would like to take advantage of them, please let Andrew know. So thank you, Andrew, for your time today. It's much appreciated. You certainly, I learned something new. That's always good, and you spelt that out very simply. So that's awesome. Thank you for that.
No worries. Thanks, Sam. Cheers. Thank you, folks.
Take care.